Welcome to the Capital News. I am your host, Alex Karitis. Today is March 25th, 2019. Thank you so much for joining me. I hope everyone is doing well today. So some of the news in the markets, the S&P was down 2 points. The Dow was up 14.5. The NASDAQ was down 5 points. And the Russell 2000, the small cap index, inched up 7 points for the day. Oil remains around $59 a barrel. Gold moved up a little bit and now settled at $1,320 an ounce. Silver sits at $15.54 an ounce, and the 10-year Treasury continued to move down and now sits at 2.2%. So there was not a big continuation of Friday's decline. However, we did see a big drop-off of markets out in Asia. The Nikkei took a big hit. The Hang Seng took a big hit, down 3% and 2% respectively. Although at the time of this podcast, again, I do these late in the evening on the east coast of the U.S., the Nikkei is rallying back rather nicely and recovering a lot of those losses from their Monday trading. So we'll see if that continues. A lot of this may have been overblown. Again, one day does not make a trend, although it was on the back of continuing poor economic data. If you follow this podcast, you know that that's no surprise. So why the markets are surprised by reality is beyond me, except for the fact that we are in a bubble, a big bubble, the mother of all bubbles. The fact that everybody is basing their strategy off of hope, which is not a strategy, or if it is one, it's a very poor strategy. We want fair value. That's what we want. That's what I want anyways. I mean, I know a lot of people just want this thing to keep going up, up, and up. That's not how it works. You know, a lot of times you hear, well, the markets were up today. It was a good day. It was a good day on Wall Street. The markets went up. I don't get why that's good. If it's good because there is innovation in market progress, I guess you can say that's good. But if prices just went up because you have central banks around the world printing funny money and governments going up in debts beyond their eyeballs, just making debt slaves out of current generations and future generations and generations that don't even exist yet, that's not a good thing. At least in my opinion, that is not a good thing. So it sort of bothers me. It's kind of a pet peeve when you turn on the news and you have people either read off some of the highlights or you watch a lot of the financial news networks, Bloomberg, Fox Business, CNBC, whatever, and they say, well, the markets were up today. It was a good day. No, I don't buy that. I just don't buy it. It's good if there is a strong economy underneath it. That's a good thing. That's a good thing. And if you have stocks reflecting that because they are organically growing their businesses, they are becoming more competitive. They are becoming more efficient. They are offering better services, better goods at better prices, better quality. That's a good day. Just because it goes up, because we got out of control central banks and governments, that ain't a good day. That ain't a good thing. And we're all going to pay the price for it. So I don't like it when they say that. And I don't necessarily like it when they say markets went down, it was a bad day. That's not necessarily a bad thing either. Maybe we're supposed to have some sort of correction of some sort. Again, we use the word correction, and we run and hide from it. It's like, come on, guys, get serious here. I mean, I think I've used this analogy before. I mean, it's like writing a paper and taking it up to your English teacher or professor, and it's before it was due, and you just want them to overlook it, and they do, and there's a whole bunch of red ink on it. Well, they made corrections. That means it's now going to be better when you take into consideration what the professor just advised you on. That's a good thing, not a bad thing. So we look at these words kind of in a weird way. We fear corrections. We shouldn't fear corrections. What we should fear, or I should say more or less be concerned about, is out-of-control governments and central banks doing what they're doing and what they've been doing, especially over this last decade, where it's just been the pedal to the metal with continuous money printing, with continuous deficit spending, it's just making this world awash in debt and liquidity that is pushing people further and further out on the risk curve, which simply means that people are making decisions that they otherwise would not have made if they didn't have this funny money in their possession. People wouldn't take the kind of risk that they are taking if they didn't have this type of money in their hands. And it's not everybody, but it's a lot of the people, and it's enough of the people where this can turn into a very, very bad scenario. And I believe that's what's going to ultimately happen, because this is going to be a huge correction. You know, typically you say, well, it's a correction. Maybe it's just 10%. from the standpoint of the stock market, or it's 20%, it's a bear market. Then you can have other corrections that really, well, now it's a recession, or worse yet, it's a depression. Then it becomes a question of the significance, the severity. So is it a great recession? Is it a great depression? Those become the serious questions. This is what's coming. It's either going to be another great recession or, unfortunately, perhaps another great depression. All you have to do is use some common sense. And we're going to get to some other topics here today, obviously. But a lot of the story in the news back on Friday, continuing today, was that the U.S. yield curve inverted. So when you're looking at the 10-year Treasury against the 3-month Treasury, you have a negative yield, okay? That's a yield curve inversion. It's yielding what we have here, a couple negative 0.02 basis points, something like that, okay? This is a leading indicator that a recession is on the horizon. Historically speaking, it does not mean that a recession is going to take place tomorrow, a few months from now. A lot of times, it's indicative of a technical recession taking place several months into the future, 1 year, 18 months, something like that. But nevertheless, it throws a whole bunch of markets out of whack. It is headline-driven, and it caused panic. And that's why we saw the big sell-off that we saw last Friday. And because that happened more so in the afternoon, European time, U.S. time, it didn't affect the Asian markets. That's why on Monday you had a huge sell-off in the Nikkei, the Hang Seng, and a lot of the other Asian markets. But like I just said, at the time of this recording, at least the Nikkei is up, rallying nicely, getting a lot of those losses back. We'll see if that continues. But this was the news. What are the headlines today? Well, it continues with the yield curve. The yield curve was a much bigger problem on Friday than it was today, because now you have a whole bunch of people on the financial mainstream media out there saying, well, it's not really that big of a deal. And then you have people saying, well, this time's different. And let me just tell you guys, whenever you hear people come out and say, well, this time's different, run for the hills. Don't listen to them. If you have money with them, get it out, because they don't know what they're talking about. That is one of the worst sayings that anybody could say. Well, this time's different. No, it isn't. No, it isn't. In fact, this time's worse. This time is even worse, because if you go back and you look at some of the history on this stuff, and you actually pull up a graph, and you look at the 10-year Treasury against the 3-month, or you look at the 10-year against the 2-year, those are typically the two that academics, the Federal Reserve, market practitioners, those are the yields that they want to look at. Those are very indicative of an oncoming recession. So if you're going to take the time and look at the 10-year versus the 3-month, because that's the one that has technically inverted in negative territory. If you go back and you look at just the past couple recessions, so if you go back and you look at the 2001-2002 recession, you had a lot of that with the onset of the dot-com boom, right? Well, that was equity. That wasn't a lot of debt. That was a lot of equity. And you also had demographics moving the economy up nicely, piling into the stock market, created a huge bubble that ultimately burst, but you had a lot of things going for the economy and the stock market. And it was primarily equity-based. It wasn't debt-based. But just a few years after, you now start to have all of the subprime stuff taking place, all of those shenanigans. And now you have the run-up, 05, 06, 07, boom, 08 and 09. Now it's not an equity problem as much as it was back in 2000, 2001, 2002. Now it's a debt problem. And now everybody and their mother is involved, because now it's debt, because debt is always owed to somebody else. And now you have a whole host of other things. And now you have also the demographics starting to shift away. They weren't as strong as they were only a handful of years ago. And now, 10 plus years on, the demographics are even worse. And households and consumers and businesses and governments all have more debt than they've ever had before. So if 08, 09 caused that type of a problem with those amounts of debt, what do you think is going to happen now when there's even more debt in even more places in the economy? It's going to get even worse. That's common sense. It's not doom and gloom. It's reality. It's common sense. I'm not here to lie to you. I'm not here to give you a strategy of hope. I'm not here to tell you that this time's different, everything will be fine. I'm here to tell you the truth. I'm here to give you my opinion and analysis. I'm here to tell you how to prepare for things, or at least be prepared and be aware. Don't be blindsided at the very least. Don't be blindsided. How you handle your portfolio and whatever you do is your business. You can talk that over with your uncle, your cousin, your nephew. I don't care. Talk it over with your financial advisor. Do what you have to do. But have a plan and stick to it. Because this is not going to end well. We have an enormous amount of corporate debt. $9 trillion. That's in bonds. That's in commercial and industrial loans. That's on leveraged loans. Leveraged loan is a loan on top of a loan. So when you look at the default rates, they're very low. They are extremely low on commercial and industrial loans because they continue to borrow more money to pay for the other money that was borrowed. Not a good setup, especially at the end of a business cycle and at the end of a credit cycle that is going to go out with a bang. Big bang. Not good. We know we have $700 billion in investment-grade bonds coming due through 2019. We know we have a few $1 trillion in investment-grade and junk bonds coming due over the course of the next 3 to 4 years at the end of a business cycle with interest rates going up. So what's going to happen? This is not a recipe for success. This is a recipe for disaster. We have an economy, we have leading indicators that are very indicative of oncoming recession in the next year or so. That's going to slow things down. Markets are supposed to be forward-looking. They're supposed to be. Will they? I don't know. What's the Federal Reserve going to do in response to this? Are they going to be wait-and-see mode? We know, at least from the standpoint of this last meeting that we had, what was it, last week already? It's going to be wait and see. There is no projection of any future rate hikes for 2019. Perhaps one in 2020. But now when you have all of these interest rates going down all over the world, you're almost pricing in that they're going to do a rate cut before they do any rate hikes. You also have the Federal Reserve's balance sheet that is continuing to unwind until the end of September. But then if you understand the mechanisms of quantitative easing, it appears that quantitative easing number 4, will continue after September. To what degree remains the question, because you're going to have a whole bunch of other data that takes place. You also have the Federal Reserve continuing to move down their GDP forecast for 2019 and for 2020. This will also be a trend that will continue not only from the Federal Reserve but from other central banks, from the IMF, from the Banks for International Settlement, from the World Bank, from corporate banks. I mean, J.P. Morgan, investment houses, Goldman Sachs, they will continue to move their GDP forecast to the downside. What's going to be very interesting over the next, month or so is going to be the fact that we are in the midst of earnings season because it's already the end of March, so we're already at the end of the first quarter of the year, if you can believe it. So now we're going to see how well these companies are performing, and not only how well did they perform during the first quarter of the year, but what are their projections for the remainder of the year. Of course, we will continue to see some companies beat. We will see some miss. Always happens. The question is, to what degree? What's the sentiment? What's the psychology? How do we respond to it? Because there's a lot of times in this funky market that you have companies that beat, but their stock takes a beating and it goes to the downside. And you have vice versa. You have stocks that miss and the stock price rallies. I mean, you can't make this stuff up, but this is what it does if you pay attention to the markets. This is what it does. That's why trading, being a day trader, is very dangerous, because you're talking about these binary decisions. I mean, there's a lot of times where I said, well, I think a company's going to beat, and it does, but then the stock gets beaten up, or vice versa. It's just what happens. So it becomes a dangerous game to play trying to chase those things. I advise you not to. Not everybody is going to be right 100%. Nobody. Especially me. I don't pretend to be right 100% of the time. I guess you always try to be right every time you go and make a trade, but you have to understand that you're not going to win every trade or investment that you get involved with. And you always have to do that. And if you're of the mindset where you always have to be right or you can't take losing, then just pay attention to the markets for sport, for game. Don't get involved, because if you don't have the volatility, if you don't have the stomach for the volatility, stay away. Just stay away. So earnings season is going to be very telling. The other interesting thing with earnings season, and I had this conversation in a previous podcast, is the fact that we have share buybacks, which has been an integral driver for share prices over the past few years especially. We had record-breaking share buybacks that took place in 2018. At present, if we maintain this current rate in 2019 will be a record-setting year and will outdo 2018 as far as share buybacks are concerned. What's interesting, during earnings season, companies are not allowed to buy back their shares because it gives the look of there might be some, insider trading going on. So they can't do it. So there's a blackout window. That blackout window starts this week. It's going to pretty much take place all through April, and it will continue for the first week or two into May. So where is going to be the catalyst to keep the stock market going up in this V-shaped recovery that we have seen since the end of December of 2018? We have the Federal Reserve that's wait-and-see mode. We didn't get any huge rally from the markets then, especially after we got the huge drop-off last Friday. So that just washed out anything, because all we saw after the Federal Reserve speech was a little bit of a decline that day on Wednesday, a decent rally to the upside on Thursday, and then that completely got washed out on Friday because we had all of the economic news from the U.S., the yield curve, and then a whole bunch of issues out in Europe with a whole bunch of purchasing managers index declining a lot worse than was anticipated. We know this. You pay attention to the Capital News, you know this. It's not a good picture. It's not a good climate. We're not here clinging to hope. We're clinging to data. We're looking at the news. We're looking at the facts. We're looking and reviewing and analyzing the fundamentals. Because the markets will always catch up to the fundamentals. It will always happen. Always happen. You just have to have the stomach to deal with the short-term volatility that takes place in the interim. And you have to act accordingly. That's it. And again, if you can't deal with that volatility, then stay out of the market. Can't take the heat, get out of the kitchen. So where's the catalyst going to come from to keep this market going to new highs? I have no idea. Unless it's more of the funny money taking place, some backroom deals, whether it's the Bank of Japan that continues to buy shares and equities within the Nikkei, whether it's the Swiss National Bank that continues to buy equities in other markets. The Swiss National Bank owns quite a few tech companies, a lot of shares in U.S. tech companies. So, the funny money can go anywhere, and we don't audit the Federal Reserve. So the Federal Reserve is not technically or legally allowed to buy equities. But that's not to say that they're not doing something pretty shady behind the scenes. They're not audited. Beyond audit, I want them gone. End the Fed. End the Fed. You got to do it. You want to solve problems, you got to end the Fed, you got to get rid of the income tax. You don't do those two things, you're nothing to me. You're not a serious player. You're just kicking the can down the road. You do those two things, you got my attention. But of course, nobody talks about this stuff. So where's the money going to come from to propel these stocks to the upside? The only thing would be huge earnings beat across the board. One company after the other. Boeing, Caterpillar, Alcoa, Apple, Microsoft. One after the next. Boom, 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 boom. They would have to beat. That's the only way you're going to have an incline, a continuation of this V-shaped recovery to the upside in these markets, because there's just nothing there. Because if you look at some of the data, we know that net, foreign investors have been net sellers of U.S. equities. And now you have an inverted yield curve. So you have a flight to safety. A lot of people are going to go into government debt, U.S. government debt specifically. All that's going to continue to do at the longer end of the curve is continue to push down rates, because people are going to be piling into the longer-term treasuries. 7-year, 5-year, 10-year, 20, 30-year. That's what we're seeing. You have to remember, bond prices and yields are inversely related. So if these bonds are catching a bid and are increasing in price, the yield is dropping. And we see the 30-year well below 3%. It's at 2.8-something%. 2.8-something% today. You now have the concern with shorter-term risk. That's what the yield curve tells us, that there is near-term uncertainty, that there is likely a near-term recession on the horizon. So people are getting out of short-term bonds, so they sell them, and so you have higher yields. So that's what causes the inversion. So this all makes sense. Markets are behaving in a rational way when it comes to the bond market. Here's the interesting thing. If you have 3-month, 6-month, 1-year treasuries that are yielding more than 2-year, 3-year, 5-year, 7-year, even 10-year bonds, why would you put your money away for 10 years when you can put it away for 1 year and get an even higher return? That's what you have to be on the lookout for. When does that reverse? Will it reverse? Because if you can get 2.5% putting your money away for 6 months or 1 year, why wouldn't you do that? Why would you put it away for 10 years to get the same thing or less? That's the question. That's the question, because you have to understand when it comes to the short term here, when you're trading in bonds, what is the market saying when you have higher yields at the lower end of the curve? It's saying, in this case to the government, to Uncle Sam, oh, wait a minute here. I might be happy to lend you money, but there are some short-term risks on the horizon here, and you're going to have to pay me something a little bit higher, which is the yield. So that's what the market is saying. Oncoming recession, Uncle Sam, other governments around the world, you're going to have to pay me a little bit more money to lend you money for the short term. And that's what we're starting to see. The next question will be, will there be people moving out of the stock market into the bond market? That's the next question, because then you're going to continue to see lower rates in the bond market, and then you'll continue to see lower prices in the stock market if you have that type of flight to safety. And we're also seeing a huge amount of debt, of government debt, that is yielding a negative return, especially in Europe. We have the 10-year German Bund, that's yielding a negative return. We have Japanese 10-year bonds yielding negative returns. I mean, you can't make this stuff up. This is not a good environment. You know, when you put your money away, you expect to get paid back principal plus interest. Well, in this case, you give money to these governments, you're getting less back than what you gave them. It makes no sense whatsoever. But this has been the economic paradigm that we have been existing in for the past 10 years because, again, you have no accountability in government. You have no accountability with these central banks. Nobody overrules them. It's the wild, wild west. And you don't get the money. You get the higher prices, though. You get the higher cost of living. You get no savings. You get no interest on your savings. You're on a fixed income. You're screwed. Look what it's doing to younger generations. $1.5 trillion in student debt. Can't pay it off. Record amount of credit card debt in defaults, in delinquencies. Record amount of defaults and delinquencies coming, delinquencies rather, on the 7 million auto loans that are 90 days plus past due. That's worse than what it was at the height of the Great Recession. And we're told this is an economic miracle. We're in the best time ever. It isn't the best time ever. Look at the data. Listen to yourself. Turn down the volume. Everybody's trying to sell you something on a financial mainstream media. They all run money. Most of their books of business is to the long side, meaning they can only buy stuff. They can't sell stuff short. That's why they're always out there saying buy, 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 because that's how they make their money. And a lot of those guys make money whether or not you win or lose. So they're always going to tell you to get in the market, get in the market, get in the market. You can move. You can be nimble. You can buy, you can sell short. Don't be afraid to do both. Don't be afraid to get into cash or gold or silver and some other things that might not be as popular right now on the mainstream media, but is going to protect and hedge your portfolio. Do what's right for you. Don't be somebody who simply follows the herd for the sake of following the herd. Do what's right for you. You will appreciate it at the end of the day. Thank you so much for joining me today, ladies and gentlemen. It's been a pleasure having you as always. I'm most definitely going to keep everybody informed of this, whether it's more breaking news or developments with the yield curve, whether it's the share buybacks, the black window that we're going in there, whether it's earnings season, whether it's breaking news from something else. I am here to give you the lowdown. Thank you so much. Please like, share, subscribe, get the word out, leave your comments. I'd love to hear from you. This is the Capital News. I am Alex Karitis. Godspeed.